A tax verification system mathematically engineered to be self-enforcing is currently hemorrhaging tens of billions of dollars. To find the flaw, we start with the atomic theory of tax evasion. In a standard single-player game, an isolated taxpayer calculates the potential reward of hiding income against the risk of an audit. Governments attempted to solve this with the value-added tax, using third-party reporting to turn every transaction into a mutual audit. This creates a verified match. Under VAT logic, a buyer's incentive to record a transaction perfectly opposes the seller's incentive to hide it. If the seller hides the income, the buyer's invoice automatically flags a mismatch, triggering an immediate system failure. Third-party reporting deters an individual firm, but it operates on a fatal assumption that trading partners will always have opposing interests. In reality, that assumption has collapsed. The European Commission estimates the annual VAT compliance gap at 128 billion euros, much of it tied to criminal networks. The scale is equally severe in Mexico, where the tax authority detected 1.6 trillion pesos linked to simulated operations between 2014 and 2019. This is collusive invoice fraud, an attack where two parties cooperate not to avoid the verification system, but to weaponize it. Instead of hiding a transaction, criminals manufacture a matched paper trail for a service that never occurred in physical reality. Because the forged data perfectly satisfies the system's matching logic, the transactions look legitimate to the central node, leaving traditional audit triggers entirely silent. The verification mechanism fails at its core when multi-party collusion overrides the system's internal checks. The domestic architecture of this fraud is best seen through the Mexican operational model, which relies on two specific types of nodes. On one side is the EFOS, a dedicated shell company. On the other is the EDOS, a legitimate firm looking to evade tax. The shell company issues an electronic invoice for a phantom service, charging a 5 to 10% commission. This fake invoice inflates the legitimate firm's expenses, lowering their corporate income tax. Simultaneously, the firm uses it to claim a fake VAT credit against taxes owed. The shell company collects the commission and then deliberately vanishes. It absorbs the tax liability but remits nothing to the Treasury. This topology allows established companies to outsource the risk of tax evasion to disposable proxy entities. This mathematical fraud adapts to multi-jurisdictional networks, as documented by the European Public Prosecutor's Office. The structural loophole exists because of the 1993 abolition of fiscal borders. Cross-border business-to-business sales in the EU travel at a 0% VAT rate. In a missing trader scheme, a broker imports goods tax-free. They sell domestically, charging local VAT, before instantly disappearing without paying the state. This becomes a carousel when buffer firms route those same goods back across the border, allowing the zero-rating cycle to repeat. Law enforcement efforts like Operation Admiral have uncovered the reach of these networks, identifying nearly 3,000 entities responsible for 2.2 billion euros in coordinated losses. Whether it targets domestic income or cross-border VAT, the vulnerability is the system's reliance on asynchronous verification of a trusted paper trail. If collusion is so profitable, why do these networks rely on suspicious, short-lived shell companies instead of colluding with established suppliers? The answer lies in the Clevin-Kreiner-Sayaz constraint, which highlights the risk of verifiable business records and the role of the informed employee. In any large organization, the probability that an insider exposes the fraud approaches absolute certainty. To survive, the fraud must modularize. Criminals use dedicated shell entities with 0 employees and 0 infrastructure to keep the coalition small and minimize leak risks. The ghost company serves as an absolute mathematical necessity to defeat the coalition constraint and completely prevent internal whistleblowing. Faced with these ghosts, states have traditionally relied on the economics of deterrence and post hoc auditing. In standard deterrence theory, the expected penalty is the fine multiplied by the probability of being caught. Authorities can raise penalties to 9 years, but applied to a shell company with 0 assets, the expected penalty remains 0. Because a missing trader is engineered to be a one-shot player that exits before enforcement arrives, traditional reputational or financial threats have no impact. When an enforcement regime faces a strategically judgment-proof ghost, statutory penalties carry no weight. The only viable lever is the speed of detection. Authorities are now shifting toward real-time digital clearance to move the probability of detection as close to 100% as possible. Systems like Mexico's CFDI mandate or the EU's incoming digital reporting rules require invoices to be cryptographically validated by the state before they become legally valid. This digital pre-clearance generates a massive, real-time dataset, allowing authorities to apply directed graph theory to the entire national tax base. Machine learning algorithms search this temporal graph for strongly connected components, circular transaction loops that indicate carousel fraud. Identifying these unnatural cycles allows authorities to intercept the fraud at the exact moment the invoice is generated, stopping the missing trader before they can vanish. By transforming tax enforcement from an asynchronous manual audit into instantaneous topological network analysis, authorities finally closed the loophole that made collusive fraud possible.